All right, guys, we're live. Um, I'll just wait till 7:10. That's 6 minutes, and hopefully some more persons will join in. But whatever the case, we'll begin the class at exactly 7:10. So please let me know if you can hear me. Let me know if you can hear me. All right, David. Good to have you here. So we'll just wait for another 5 minutes and then we're good to go. And I hope that what you are seeing on your screen is the course itself. Hi, Deborah. Welcome. Okay, 4 more minutes and then we start. So I'll be talking about um, why people should stop trading. And by trading, I mean trading financial assets in the way that most people currently do. That's what I'll be talking about. And I hope to wrap this up before 8 p.m. or before 8:10 p.m. in that case. 1 hour max will be done, or less than 1 hour will be done. In 2 minutes, we'll begin. Okay. Um, we'll be starting now. So in this webinar, I'll be talking about why trading won't give you financial freedom and what you should do instead. So that's why it's titled Stop Trading, Start Investing. And I'll begin by reminding you of what trading really is, or what the popular um, um, activity that the popular economic activity that is called trading really is, which is simply buying and selling of utilities, whether it's goods or services. It's very important that we remember this particular kind of activity and how that this is the real thing that ought to be called trading, you know, every time. So in this particular activity, like in the first frame, you can see that's a shop where bags are traded. In the frame to the right, a grocery store where um, groceries are basically traded. And then down here, down here, you can see that this is actually an online store where antiviruses for computers are traded. And then to the right is buypower.ng, basically a platform that sells electricity units to Nigerians. So the bottom line here is that what trading really is, or should I say what trading ought to be, is when an individual or a company buys an already produced, you know, good or service at a certain amount, which the producer or say the major distributor sells to them, and then they mark, they have a markup. In other words, they themselves fix their markup depending on, of course, a lot of economic factors and sell. That is trading. In this kind of trading, the items or services that are traded have utility. The man who sells or woman who has a bag shop knows that after selling off this set of bags, people will come and buy more bags. So they go back. And why are people coming to buy more bags? Because bags have utility. Same thing with food. Same thing with antivirus. Same thing with energy. I hope you get this concept clearly, or you remember this concept. I mean, this is something that we all should, in a sense, we all already know, right? So, having established this or reminded you of this, we'll move on to what I'll really be talking about today. Trading financial assets. Now, here's the definition of a trader I got from Investopedia. A trader is an individual who engages in the buying and selling of financial assets in any financial market, either for themselves or on behalf of another person or institution. The main difference between a trader and an investor is the duration for which the person holds the asset. Investors tend to have a long-term time horizon, while traders tend to hold assets for shorter periods of time to capitalize on short-term trends. Um, in any case, if I were to edit or add to this definition, I would add that the main difference between a trader and an investor is the duration for which the person holds the asset. Investors hold the asset and the way in which they also benefit. That is the way in which they also benefit, get value from that investment is a huge part of the difference between a trader and an investor. Then another thing that you would find, you know, rather interesting is that you would notice that for traders, they said that's the last sentence. Traders tend to hold assets for shorter periods of time to capitalize on short-term trends. There is no mention of how trading has anything to do with value from whatever assets that are being quote unquote traded. Everything here talks about everything here is talking about trend. It points to the fact that it's just a trend the trader of financial assets are trying to ride on. It's why when you listen to the news or read the news, you'd hear things like investor sentiments. So these are sentimental things. It's not necessarily hinged on any kind of value that the buyer and or seller in this category of trading financial assets are going to get from what it is they are trading. They are just trying to make money off of a trend. That's simply what it is, right? So it has nothing to do with value itself. It's key we remember that. So these are some of the trading, or should I say, these are some of the platforms, or should I say, items or financial instruments that a lot of people usually trade. So you have crypto, futures, you have commodities, forex, metal, stocks, and I know that the three most popular ones is crypto, forex, and stocks, and those are the three I would really be, talking about. But in general, all of these activities or trading any of these things I just put up here falls under the same activity, just really slight differences. The um, the primary mechanism, the basic mechanism of how all of these things are traded is the same. It's just riding on a trend, hoping that a particular thing happens and then you make profit. You are not directly in control of it, unlike the last slide where we talked about this um, um, you know um, trading utility, buying goods and services, right? So that's basically the difference. So here I'll talk about pitfalls of trading financial assets. What are the pitfalls of trading financial assets? Pricing is not directly determined by each trader. So this automatically makes such activity speculative, which eventually makes huge losses inevitable. Most people who are into trading of any kind of financial asset, be it stocks, crypto, forex, whatever, usually don't like to agree or believe that they would eventually lose. In fact, they tend not to see it as a speculative activity. They tend to want to um, believe that they have some kind of control over that activity. But in reality, it is not so, because when it comes to the price movement of any of those things I had earlier mentioned, right? The in the trader does not have any control over pricing, right? I hope I'm making sense so far. The trader does not have any control whatsoever over pricing. So it makes it speculative. Unlike the man who goes to buy bags at 10,000 naira each, he can mark it up to 20,000 or 30,000. If anything happens, he can increase the price again. He can always keep it profitable. He can also decide to do sales and sell off everything at 50% off or 50% discount from his original selling price. Whatever the case is, he or she has direct control over the pricing. But when we talk about trading financial assets, the trader does not have control over pricing. So how is that really trading in the traditional sense of the concept, the word? So it's more like speculation, and that's why, 99.99% of those who trade eventually make huge losses that they are unable to recover from. It usually takes a matter of time. The second pitfall is because of the long period of time between bull and bear market. So a bull market is when prices are increasing, like between 2020 and sometime in middle of 2021. For crypto, for example, there was an increase in, especially in 2021, there was an increase in the price of cryptocurrencies. And I mean, for people like us who are financially minded, who understand how these things work, we could tell why that price increase was there. So here's something you should understand about price increases in financial markets. When there's when there's a an increase in the supply of money, that's by central banks. In this case, the Federal Reserve in America printed a lot of money, and they called it COVID, is it bailouts or whatever they were doing with that money. People had free money, lots of money, and then once you have that kind of situation, people tend to want to look for ways to, quote unquote, make more money with little or no work. So what do? They started buying cryptocurrencies. And the way pricing in these markets work is that the higher the demand, the higher the prices will go. Once there's no demand, the prices will crash. So it's a simple thing. They took the excess money, started putting it in, and I mean, people call that pumping, right? Putting it in the crypto space, even in the stock market too. People were just throwing money in there. So what happened was that as time, as time was passing, the their needs in real life would eventually catch up with them, and then they'll start selling off those things to try and meet needs in real life, and then the markets will crash. That's what we are seeing now. So we are currently in a bear market, even in the stock market and in the crypto space. And these periods of time are usually long. Before the crypto market will pick up again, maybe it will be sometime in 2024. So let's assume that there were even people who did not make any huge loss. But right now, they cannot make any good money from trading any of these things. What happens to them? They usually run out of cash for day-to-day living. So in that sense, it's unsustainable, right? So for 99.99% of people, trading financial markets is unsustainable in the long run. You won't find anyone. Like I said 99.99%. So if you were to cite examples of people who have continually tried to ride on the financial trends and make money off of that, right? There are very, very few that do it successfully. And one of the most successful is Ray Dalio. It was early last year. I was watching one of his videos, or late last year, where he was advising people not to try to, trade um, 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 financial markets. So in the long run, it's not sustainable. It's not sustainable psychologically either. Mental health. I know of a young man who is very I would not like to call his name. He's very vocal, and he's one of the big crypto um, um, one of the big crypto um, players in Nigeria. I was at an event where he was. Because of that, I mean, my fundamental investing philosophy is very different from his own, so we don't tend to agree. I saw him, shook him, and I sat down. And after a while, he was to present something to some people. He was invited to speak, and I noticed that his countenance was really down. Anyway, the host later told me that just before he went on stage to speak, he had lost 27 million naira. And then some weeks later, I was speaking to the host, who is our mutual friend. He told me that he has actually lost more after that day. That's because what he thought he had built during the bull market was really just building castles in the sand. Right now, there is no activity to generate those profits anymore. And I mean, a lot of these monies are other people's monies too. So it's not sustainable. I've seen it both in the stock market. A good example for the stock market example would be what happened to Abayomi is his name. He was the owner of Stocks Watch. And Stocks Watch philosophy was again trading of stocks. So he would do analysis of how he bought a company stock for 5 naira per share, and it went up to 18 naira. They sold, they made so much money. It's the same thing when the markets in the world crashed between 2008 and 2009. Those companies like Stocks Watch, as big as they were, they all failed, and right now they are no longer in existence. So this is what you would consistently see, this kind of trend, even for multi-billion dollar businesses like Goldman Sachs even almost failed in 2008, 2009. Bear Stearns, a multi-billion dollar investment bank, failed. Lehman Brothers, a multi-billion dollar, they did not, the money that they were worth wasn't even really the issue. It was the nature of the activity, that speculative activity. Because when the bust comes, it would anyone who is exposed, it would tear the person apart and put an end to whatever business or financial advantage you thought you had. Like Warren Buffett usually puts it this way, or he put it this way in one of his quotes, that when the tide goes down, river tide goes down, we will see those who are swimming naked. So during bull market, it seems like everybody is making money, like everybody is as an investor, until the market crashed. Whether it's stock market, crypto market, forex, doesn't matter. Then you see those who were exposed, who were not really investors. They were just, riding the trends. So I hope I have done justice to this. Please let me know. So proper use of crypto. Now there's something I don't do. When I tell you that a particular activity on a particular platform is not good, I don't end it there. I also tell you what that thing could be used for, or what it is best used for. So in this case, we'll look at crypto. Basically, crypto, the basic categorization is that you have coins. The coins are actually um, cryptos that have a blockchain, that are direct, they have their own blockchain unique to them. Tokens are other coins that are built on the blockchain of another crypto. So that's it's like the tokens are like a secondary coin to the major, to the primary coins like Bitcoin, Ethereum, and the rest. So that's the basic difference. So proper use of cryptos as a means of trading goods and services. I think sometime last year I did a deal for a while for someone. I have a brother in the US, and we're buying used iPhones from factories for the guy. Because of all the CBN laws and all of that, what we're using was crypto. he buys crypto in from Nigeria or from Nigerians here, and then he sends the crypto. My brother, immediately this transaction usually happens in less than 5 minutes. So my brother sells the crypto, sends to my brother, he sells the crypto there, gets the dollar equivalent, and then buys the goods. So as a means of trading goods and services, that's what cryptocurrencies were originally designed for. So their original purpose is to replace fiat currencies. And so an argument I usually make is it not ironic that um, people are happy when they say, "Oh, my one Bitcoin went up from $10,000 to $30,000." Now they are viewing their Bitcoin, which they are supposed to actually use and buy and sell, they are now viewing it in terms of the fiat currency that the Bitcoin is supposed to replace and trying to make profit off of that. So their joy is that they increased their their crypto's valuation increased in terms of another fiat currency or in terms of a fiat currency. So that mindset defeats the purpose of cryptocurrencies in the first place, right? I hope this makes sense to you. So so people would ask me, so ideally, what should be the matrix for the success of Bitcoin, as an example? The number of transactions. If there was a way they could show us the number of transactions, that's for buying and selling of goods and services, that Bitcoin and say maybe Ethereum, carries out, or people use it for every day, right? That would be a good metric to measure how useful these cryptocurrencies are. But actually, people don't use them for that. They just tend to want to, speculate with the prices. For bypassing limited banking processes for international. Okay, I already talked about this with that. My brother's example. The buying of iPhones. So this helps you when governments are putting so much restrictions in place. Use it for whatever it was designed for. So some tokens, like some tokens are designed to help with things like NFTs and all of that. So they have different purposes. You can use cryptocurrencies for what they were designed for, but once you move into the realm of quote and unquote trading, you've entered into speculation. And like I've already outlined or stated, you would eventually, make huge losses. Proper use of forex, basically borrow the change. So when people tell you they are forex traders, they are not actually really trading forex. The people who really trade forex are, that's when I say forex now, foreign currency, just basically exchanging or selling foreign currencies. That's what forex is about. So in this picture here, you can see that this is a bureau de change, right? That man is probably a traveler that went into a country. He came with his country's currency. Perhaps he wants to convert it to this his destination's currency now. That's what you have these BDCs for, right? So for a BDC, they usually will have many currencies. For example, in Nigeria, it would be the northerners, Abuki, like Abuki, okay, not Abuki FX, but you know what I mean, the ones on the street, you know, who you go sell your dollar to or even buy dollars from, right? So those are BDCs. And for them, their exposure to risk is very little. I would explain. So, for example, the Abuki Nigeria has a lot of naira and a lot of dollars and a lot of pounds at the same time. So where people think that, oh, the dollar is the naira is depreciating against the dollar, that means the dollar is increasing in price when you price it in naira. The Abuki is making a profit, but that's not where he really makes his profit from. So even if the reverse happens, where the naira begins to appreciate and the dollar depreciates against the naira, the Abuki is still good. Where he makes his profit from is at the point you want to buy the dollar or sell the dollar, they have a spread that they are going to charge and make money off of it. It's almost like buying and selling commodities for them. But the activity that is called forex trading that happens online is different, completely different. What happens is that people are betting on the direction a currency pair will go. So they take position, like if you say, okay, USD, Great British USD yen, let's say USD yen, right? They go long, which means they are saying that the USD will increase, will appreciate against the Japanese yen. It's just a bet they are making. It's speculative. So they don't have any dollar or yen. They are just taking a position that if it goes in that direction, they make money. If it doesn't, they make losses. If they go short, it's the reverse. So that's basically what they do. They are not selling anything. They are not selling. So for the people who are selling will be BDCs, right? Like this. So that's that. Proper use of stocks. So this is Nigerian Exchange Group, formerly known as Nigerian Stock Exchange. Proper use of stocks will be as a means of buying ownership in profitable businesses. In fact, that is why the okay, let me talk about the abnormal use of stocks first. Most people would say, I'm investing in stocks. What they mean is that they want to buy the stock of a company, hoping that the price will go up in a given period of time, and then they sell it off and make profit. In fact, in reality, there is no such thing as investing in stocks. If you understood what the primary purpose of the capital market is, what it was created to do, it was created as a platform to give companies access to public funds. So companies that want to raise money to expand their businesses go on that platform and sell part ownership, which is what you call shares, of their business to either governments, other companies, or individuals, right? By so doing, those other entities become part owners, what you call shareholders, but they're actually part owners of these companies. I give an example here with GT Bank, First Bank, Dangote Sugar. These are businesses that are running in Nigeria that you all know. These businesses, just like your own business that you own or the business where you work, all of you listening to me, you are either working in a business or you own a business, right? So, um, Madam Mira Okorafor, you are quite late, and I hope you don't misunderstand what I'll be talking about at this point. However, you can always, you know, get the replay. So the idea of the capital market is that you, as an investor in these businesses, you start sharing in their profits, and also you partake of their losses also if they although you don't bring more money if they lose, but what I mean by partake is that you will not get any profit for the years where they don't make profit or share profits. So the idea is that you are supposed to use stocks as a means of buying ownership in profitable business, not just any business. So the moment you understand that, this thing I explained to you, you begin to look at the capital market very different. Like, oh, this is just a platform. It doesn't mean that I can go and buy just any stock because they are saying that stocks are going up. So you would now start from, instead of starting from, oh, I want to buy stocks, it's no longer about, because there's really no such thing as buying stocks, frankly. It will now be, oh, I'm looking for a company, or I'm looking for companies, businesses that I can be part owner of, right? So I'll be a part owner of one of the best or the best few banks. I'll be a part owner of the best cement companies. I'll be a part owner of the best agricultural companies. You get the drift, right? So you now say, so how do I become part owners of this company? You buy, of course, you have to do your research. There's a lot of work that needs to be done. Then you now identify them. They also identify periods that it's actually good to invest in them, and then you start buying ownership in these businesses, profitable businesses, because you've established that from your research, right? Now, for as long as those businesses exist, you will continue to share in their profits every year. You get consistent and increasing purchasing power from your assets and still retain ownership. This is the key point. So, unlike the other things we've been looking at, the whole crypto and all of that, all this trading, even stocks trading, notice that, and I think I shared a video on Facebook today. If you are my friend on Facebook, you can, or if you are not, you can look for Etions or Morege. I shared a video where someone was explaining something that Warren Buffett, says about the kind of assets you should invest in, right? And I also, did justice to that in my course, my company's course, where I explained to people that, look, what you ideally want is that you want to own assets that you will get value from. By value, I mean income. You'll be getting money from it. Yet, you will retain ownership of that asset. But the moment you go into the realm of buying an asset because you want to sell it and make more money, you are not investing. You are speculating. It's really one of the ways to, one of the litmus tests that you can do to know when you are investing versus when you are speculating, right? So you get consistent and increasing purchasing power. That's, I mean, by purchasing power, I mean income from your asset and still retain ownership. This is investing. This is generational wealth. This is how you actually accumulate generational wealth. And by that, I'm not just throwing the term generational wealth around. It's not a cliche when I say it. First Bank has been around for over 100 years. If your grandfather has bought First Bank shares 50 years ago, you don't want to know what the valuation will be today and how much money your family, even you, will be receiving every year. It's huge. The reason a lot of people don't pay attention to what investing really is that it's painful. It's painful for the average person to finally realize that there is no shortcut to wealth accumulation. There could be a shortcut to making a lot of money. That is accumulating riches. That is becoming rich. That does not make you wealthy. The amount of money you are able to make, you are currently making from the things you do, doesn't make you wealthy. It makes you rich. So you can be 2 billion naira rich and not have any wealth. What usually happens is that eventually, because of the way the financial system is designed, you will end up broke. I'm not saying I wish you end up broke. I'm saying that by design, if you don't convert the money you are making to wealth, you will end up broke. You will not be able to transfer anything to the next generation. That's how the financial and economic system of today is designed. Money, like I usually say, I tell people that money is an end and a means. So what I mean by that is that, like, money is a solution and a problem. That's another way I usually say it. So the reason you do business or improve your skills, work in a good job or do both is because you want to make more money. So money is the end of that activity. Profits, you make money, use that money to upgrade your lifestyle. Now, if you do not know the ultimate end, which is accumulating wealth, you just end at money. But once you understand that, oh, there's something beyond this money, which is owning, a portion of the economy by owning these businesses that, some of these businesses I'm showing you here, right? And understanding how that perpetuates your ability to receive income, right? You just not you keep taking the money you make, put it back in doing more business and then enjoying your life until you get old or until something happens, you know. Like Solomon said in, I think, is Ecclesiastes 11 verse 2, but divide your investments into 7 or 8 places. Said, because you don't know what evil might come upon the earth. The concepts I'm talking about are very old. They are not new, but they are just not common. So doing this particular thing is what generational wealth is about. So if I say generational wealth, there are families that they have passed down there are shares of some of these old companies, 2 generations. They've passed it down. Some families in Nigeria, there are not a lot of them. I think there are about 300 families that really understand this thing. So you see, just 300 families out of 200 million people, just 300 families that really understand this thing. So it's something that I know for some of you, you find this very uncomfortable to accept because it's a slow process. The way this kind of investment grows is a slow process, but it's something you must do. Like I have said, this doesn't stop you from doing your business. What you're supposed to be doing is as you make money, you take out a percentage per time. And please don't fall into that trap of telling yourself that, oh, when I make more and more money, I will begin to do this. No, this has a lot to do with time. It works with time, not amount. So what you do when you do proper investing is that you take advantage of something called the law of comparative advantage. So here's Dangote, here's Mauricio Alakon, he's the CEO of Nestle Nigeria. Here's Segun Agbaje, Jim Ovia, and Peter. Um, I think Peter something, that's the current MD of Zenith Bank. Graham Heffer of Okumu Oil. This is Herbert Wigwe of Access. So it's a question I usually ask you versus them as a group. Who is likely to make more money and remain financially relevant over the next 20 years if given the same amount of capital? I would like you guys to answer that question for those of you that are here. If you were given 60 million naira and then these men were given 10 million naira to also put in the various businesses they run, in 20 years' time, as a group, when I say as a group, that's them doing what they do versus you trying to do what you do with 60 million. Who do you think would have made more money? That's one. And and who do you think would most likely not have failed? What is the probability that the six of them would have failed versus just you failing? So that's the question. That's the question I'm really asking. Any answers? I just need 2 or 3 people to let me know who who they think will have made more money. Nobody's answering. No. Okay, I'll move on. So here's an example. This is actually a real example in Nigeria that would help you know, illustrate this how this whole thing works. I'll just run through this really fast. So on this first column, you have number of years, you have the year in question, you have number of shares owned. Then okay, let me start from the top. So this is an investment in First Bank in the year 1993, a 30,000 naira investment at a share price of 10 naira per share back then. So the number of shares that would have gotten is 10,000 units, right? So Kennedy says he would want to think it would be them. It will actually be them. It's whether you agree or not. It's 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 going to be them actually. Even they themselves do the same thing I'm talking about because they are not quite sure which of them as an individual will will fail. I mean, the example I give a lot is Yahoo and um, Alibaba. Jack Ma's Alibaba. Yahoo as a company, I mean, everybody knows that Yahoo as a company does not make good money today. But when they were making money back then, they bought a lot of, they invested a lot in Alibaba. And as their own business started failing, Alibaba started rising. And of course, we know what happened. So that in fact, some of the Yahoo shareholders today consider Yahoo to be an investment company. It more than I think it more than 85% of Yahoo's yearly profits don't come from the activities at Yahoo Career. They come from the investment in Alibaba and other companies. So Even big companies and wealthy people understand these concepts. So back to this example, right? Number of years, the year, number of shares owned, dividend per share, amount received, total income earned so far, bonus ratio and bonus shares. I'll just run through like 5 years and then I know you get the drift. Then we'll come to like the recent years. So in the first year, that was 1993, you would have owned 10,000 shares. 70 kobo per share is the dividends that First Bank gave. Now, this dividends is not magical. From the profits that First Bank made from their banking activities, from the business, it so happened that by the time they shared that profit or the parts of the profit they decided to share, each shares that anyone owned was allocated 70 kobo, right? That's how it works. So because this investor of 30,000 naira owns 10,000 shares back then, he will get 10,000 shares times 70 kobo. That would be 7,000 naira. So if the individual owned 100,000 shares, this would be 70,000 naira. I hope that that makes sense. I mean, 100,000 shares would have cost the individual 300,000 naira back then. So the total income earned so far, just for record purposes, would have been 7,000. Now, bonus ratio 1 for 1 means that for every share that investors had in First Bank in 1993, the company gave them one extra share. That's how bonuses work. Now, again, you might be asking, on what basis do companies give bonus shares? I would explain. When companies make profit, sometimes they pay part of it out as dividends. That's cash you can claim. At other times, they retain some of the money they made or all of it in some cases. So just as a way of helping the shareholder appreciate the fact that, oh, we made profit though, it's just that we are not sharing it. You know, you can have a company and then you make profit, but you don't pull out anything, you put the money back in the business, right? So they now create new shares to sort of reflect the profit that they withheld, and then they give those shares to the existing shareholders. So if you like, you can go and now sell your own shares and take the money out, or you can just hold it and then you have more shares. And whenever it is they declare dividends, you get more money. I hope this makes sense. So anyway, in 1993, 1 for 1 is what First Bank gave from the profits they made. Remember, this will not be the same case for all the companies listed in the capital market. So that's it's important that you remember that. In 1994, the investor would have had 20,000 shares as at this point. That's this 10,000 they had before plus the 10,000 they were giving, right? So a 50 kobo per share was declared by First Bank from the profits they made. I need to keep hammering on that. If the company did not make profit, you won't get any amount of money. So which means that based on the 20,000 shares they now have, you do 20,000 times 50 kobo, that would be 10,000 naira. The total earned so far is 17,000. A bonus of 1 for 4. So for every 4 shares, one was given. 4 shares, that's this bonus is based on the cumulative so far, not the initial shares that the investor bought, right? So you understand how this continues to play out. So let me take your attention to 1997. The investor at that point already had 39,062 shares, but no bonuses or dividends were even given. They are batcha years, right? So everybody knows that the economy was very bad back then. So you get the idea, right? So we can come down to um, so let's say as at the year 2009, that investor that was getting 7,000 naira per year was, you see where my laser is, right? The investor that was getting 7,000 naira per year is now getting 633,000. So if the investor was getting this had 100,000 shares and was getting 70,000 naira per year, this amount will be 6.3 million. Just so that you appreciate the amount of growth that has happened in terms of the income. Please note that what I was saying. The investor still owns the assets. All these are monies that they are just collecting from the asset, that the asset is paying them. And as at this point, the investor has collected a total of 2.4 million. If you're adding all the monies they've been taking, sounds very untrue, but I think this is what I figured out or discovered in all my research from 2001 to 2008, and I likened it to agriculture, which is where my company was named Money Culture. That's the idea, really, that a seed can become a tree. So because if I had told you that, oh, 30,000 naira can become invested without you doing anything, can grow to become, say, 100 million, most people will say, no, no, that's not possible. But it is actually possible when you understand how the economy works. So another very interesting thing you need to notice, in 2010, you can see that the income fell from over 600,000 to just about 54,000. Again, this is the after effect of the um, financial meltdown. So you understand why the income would have fallen, right? And then you see that the bonus was 148, and then the years that followed, there were no bonuses at all, even though the income began to increase again gradually to 390, 369,000, 492, 616,000, you know, and 667,000 by 2014. So you get a drift. Now, you may be wondering where First Bank is getting all these monies from. It's a business that has continued to grow as the Nigerian population continues to grow, as we technology and development continues to happen. As a bank, they continue to make more money. So you know where the money comes. But you can see that this is a 22-year time frame I've just shown you. It's not a 22 months time frame. So it happens over a long period of time. And the more money you invest, the more aggressive you are, the more money you make. And the sooner you actually attain financial freedom. So every family can be worth millions, even billions. And I'll show you how. That's the implication of what we just saw, right? The number of shares held as at May 2014, that's 22 years later, from the initial 10,000 shares, is now 616,032 shares. The average share price as at 2014 for First Bank was 13 naira 3 kobo. That means the 30,000 naira valuation for the shares would now be 8 million naira. Total dividends received during this time frame, that's now the value you got without selling anything and still retain ownership, is 4.7 million and counting, because the First Bank is still around even till today. So you continue to get paid each year so long as they make profit. Total value accrued, that's if you add both the valuation of your assets, which is the shares, and the total money you've received, 12.7 million. The average yearly inflation of 19.02%. So the average inflation for those years, the inflation in the 90s was crazy, was very high. So, but the average inflation for those 22 years in Nigeria is 19.02%. So if we apply that to the 30,000 naira initial, we want to know what the real profit is, right? Because if you had put 30,000 naira, say, in treasury bills from that time till now, it will be around this 1.9 million or 2 million today. That means you'll be making only 100,000 naira. However, because this is a company, right, that is growing, that's why you are seeing this kind of profitability. So what what this what this means is that 30,000 naira in 1993 is now was now 1.9 million by 2014. So that if we want to check what the real profit is, would would minus 1.9 million from 12.7 million. not 30,000 naira. We're not going to do 12.7 minus 30,000. If you want to see the real picture, you will do 12.7 million minus 1.9 million, because 30,000, that's the purchasing power of 30,000, right, in 1993 is now 1.9 million as at 2014. I hope that is making sense to you. So when you do that, the clear profit, the real profit is still 10.6 million from a 30,000 naira investment in 1993. That's the real profit. That's the growth factor now. The number of times that 30K multiplied in that time frame to become 12.7 million is 423.33 times, or 42,300%. So the thing is, this is what I want you to imagine. Imagine that First Bank repeats the same performance in the next 22 years. What you would have, the total value you would have gotten from that initial 30K will be 5.4 billion. This is how some families that some I even know of personally, you know, became very wealthy. It's not necessarily because anyone in the family was able to make a billion naira. It's just that a few people understood this principle while they were making as much as they could make from whatever it is they were doing. They were taking a part of that and identifying profitable businesses with long-term to lifetime prospects, and then they were just putting the money there. The concept is so simple, but very difficult to do. So the implication of what I just showed you is that medium income earners and small business owners, even school teachers, barbers, tailors, once they can meet, in fact, you don't even have to meet your basic needs before you invest. The idea is that you take out the percentage for investing first, do the investment, then use the rest and meet your basic needs. And the argument I usually make at this point is that people will say, oh, I don't even have enough money to feed. I say that's not true. There are people who make 500K more that complain that the money is not enough. There's another family that is the same number of dependents where the breadwinner or the breadwinners together make 300,000 naira a month. Their son that is 100,000 naira, and everyone finds a way to cope within what they make, right? So there's room for investing. That's what I'm trying to say. For most people, once you are in Nigeria and you don't have kids and you are doing 150K or more, even if you have kids and you are doing 300K or more, there's room for investment. Like I said before now, it is not about the amount of money you have to invest, it's the ability to discipline yourself and form that habit and take advantage of the amount of time you have left to live so that you can build something or accumulate something substantial and then leave that. And of course, you enjoy it in your old age and then leave that to the next generation. I know there are many questions that will be running through your head. What about the risk? What about if the company failed? There are answers to all of that. There's something we do in our company called economy ownership. That's basically the principle we operate. With that particular approach to investing, there's no way your investment, will fail. As a collective, portfolio. So how do you start investing? An investment in knowledge pays the best interest. And when it comes to investing, nothing will pay off more than educating yourself. You do the necessary research, study and analyze before making any investment decisions. This is a quote by Benjamin Franklin. And like I like to say, you know, rounding up, is that a wealthy person is not wealthy because of what they own. Wealth is first and foremost a mindset. It is a it is a financial frame of mind where owning portions of businesses is more important than making money. So that you are making money primarily to own as much of those businesses as you can own. Then what do you live off of? Of course, the money that those businesses make and give to you will now be eventually what you are planning to live off on. It is that this mindset where you are not money conscious, but you are investment conscious that makes you a wealthy person. your financial behavior changes. And then rather than just chase money as an end, you're trying to get money to own more and more and more. That's why they tell you the rich get richer and then the poor gets poorer. It's actually that the wealthy gets wealthier and then the rest get poorer. Because by the design of the system, these businesses, as I said, as a collection of businesses that form the pillars of the economy, they just continue to grow. The families that own them continue to get wealthier and continue to receive more money to spend without doing any work. So it begins with knowledge. And that's where we come in as a company. Money culture was established in the year 2008 as a wealth education and wealth management company. So, uh, just to answer some questions that some of you may have after listening to this, we we as a company, we only okay, should I say we practice what I call education-based investment management. What that means is that what we are ideally trying to sell is not the investment service, even though we do that for, our investors. That's just an activity. It is the mindset behind what we are doing. So our services, because I know I studied Bob Proctor. I wanted to find out why a lot of people heard, stuff like this and then they were dragging their feet to take action. The first 5, 6 years of, rendering this service, going out to talk to people enthusiastically about it. Some people will be fired up, and I noticed that a year or 2 years later, they've still not taken action. So I then went to start studying Bob Proctor on paradigms. What make people do the things they do, and I discovered that until their paradigm changes, that's your mindset changes. Even if in their conscious mind they know that this is something I should be doing, this is something that will benefit, they will still not do it. So after that, I then redesigned how our services work. So it begins with education. That's where we lay the foundation, the kind of things you've heard now, right? We have a course that is about 6 hours long. The platform is online. Currently, it's in a closed Facebook group, but by Monday, it will be on Seller. So even if you're not on Facebook or you don't want to access it on Facebook, you can pay and access it on Seller, right? The course fee is still 140,000, even though we are trying to review that upwards. Or you can do 150,000 naira in take advantage of our installment plan and pay within 90 days. So this course basically digs deeper than what I have just told you. Now, the reason why you are wondering why people will fight over trading financial assets versus investing the way I just talked about, there's something called financial slavery. uh, Basically mental financial that keeps people behaving in a certain way when it comes to money and their finances. And then they work so hard, make so much money, and then what seems to be like somehow the money flows out of their hands back to the system. Anybody who you know who used to be very rich and became broke, their money did not get burnt or go to Mars. The money just flowed away from them back to the system. And that system is a system of slavery that keeps people working perpetually until they die. And then they have nothing to transfer to their next generation. Such that all the money they worked for, that they thought was their money, was in reality not their money. They were working for the owners of that economy. There's more of this, when you attend the course or if you choose to attend the course. Then after that course, you have access to perpetual income investment scheme. And as the name states, the title states, it's basically what we are about. It's creating a system of perpetual income. And of course, we have a community of investors who are intentionally buying ownership of the economy. That's our um, basic philosophy is economy ownership. So, like I said earlier, it's an education-based investment service. You choose between the premium investment management service and the self-service investment platform. The premium investment management gives you complimentary membership of the generational wealth lords community. So that's the community where education continues. When I say education now, we are talking um, what's really happening in the economies, real life examples, and basically we have that conversation, you know, as a community. That's what happens there. While we as a company continue to manage your investment portfolio, and these are usually long-term um, partnerships. Both the PIM and self-service grants you access to our manuscript book review insights and our quarterly Q&A sessions. So for the self-service, you don't become a member of the generational wealth laws. However, we have another channel where we also send you educational materials, reminders to invest, but the investment execution is up to you. Now, the challenge with that is that um, even though we designed it for those who cannot afford the minimum investment for joining the um, premium investment management service, right? Our hope is that eventually they are able to grow their portfolio and move over to the other side. One of the biggest challenges with wealth accumulation is discipline. If you don't have anyone to hold you accountable, you either find yourself not investing as you should, or at the slightest financial challenge, at the slightest financial challenge, you find yourself selling off your investment. So what we do in the premium service prevents you from doing all of that. And by the way, all these investment services I just mentioned, both the premium and the self-service, they are designed such that we as a company don't um, we don't have access to your funds. You don't give us your funds. The investments are made directly in your name, but we are the ones that actually make the investments on your behalf without having control over your money. So that's that. And like I said, everything is education based. So for the money script, for example, we are currently looking at a book titled Basic Economics by Thomas Sowell. So the idea is to, books like this, I read and I share insights, and then other members of the community bring in materials, we analyze, we talk about it. But what that does is that the education, it stays on your mind, right? Education continues. Like what I shared on my Facebook is one of our investors that posted it in our generational wealth lords, and then we had a conversation about that also. So with that sort of environment, the ideology is reinforced until, like Bob Proctor said, that mindsets are formed by repetition of information, and new mindsets, in other words, the old mindsets are changed and new mindsets formed by repetition of information. It's not by understanding what is being said. There are a couple of you that have heard these things I've said before now that are not acting on it as you should, or you've not even acted on it. Some of you will be hearing me for the 10th time, and then you'd feel like, how do I put it now? You become driven to want to do more, right? So that's basically what repetition of information does. Now, when you continually expose yourself to that information that you have agreed to, or even if you don't agree to it, eventually it becomes your mindset. It gets to your subconscious, and then you start behaving. It's, or should I say, the mindset starts conditioning you to behave in accordance with whatever it is that mindset, um, is about, or whatever it is that information, carries. So that's the point we are basically trying to bring all our investors to, and that is that. So if you have questions you want to ask, or you want to get more information on how to join, um, you know, take our course and eventually maybe get to join our investment community, you can follow that link or send a WhatsApp message to this number. I hope 8:15. So at this point, I'd like to know what your comments are. What's the most important thing you learned in this webinar? And if you have any questions, I'd like your questions. I'll be taking only 2 questions. So go ahead and ask your questions. And please, you learned. And if you joined us late, you kindly request for the replay of of this course so that you have a proper understanding of everything that was said. Thank you, guys. Thank you for joining the webinar. So I'll be taking questions. Maximum 4 minutes. We should close this by 20 minutes past 8. Questions, and like I said, I would like to also know the most important thing you learned. What struck you in everything I have been saying? Thank you. Index Capital said expository session. I like to know, like I said, what exactly it is you really the most important thing you gained. Deborah is asking, is this the only way one can enjoy wealth? Yeah, the answer is yes, actually. And then it's the only concept that enables you accumulate generational wealth. But the challenge is that people tend to see it as one thing. It's not. So if I own, just because I approached I use the capital market as the platform does not make my investment one thing. It makes the platform one, but the investment is in many things. I don't know if that makes sense. So that's why I keep telling people not to say that, oh, I'm investing in stocks. No, there's no such thing. Is that for example, currently I have investments in banks. I have investments in um, cement, production companies. I have investments in two palm oil production companies. So you see, that begins to sound like, oh, I have. But if I just say I have shares, then in the way that we've been programmed to see it, you think it is one thing, but in reality, it's not one thing. I hope that that answers your question. But yes, it's the most sustainable concept for Commonwealth. Yeah, Maria, you're welcome. You're welcome. I hope you take action soon because there's a lot of learning to be had. Like sometimes I usually share Dr. Strive Masiua's post where he talks about the need to understand investing, and it takes years to finally wrap your mind around it, the entire thing. You're welcome. By the way, guys, the replays are not free. They come with a token. I don't know if my colleague is here. She would, but it's less than, usually less than 5,000 naira. It's just a token for those who do not attend free, who do not take advantage of this free webinar. I think it's less than 5K. That's the replay. All right, Mark Kennedy, you're welcome. All right, guys, it's 20 minutes past 8. Thank you very much. Thank you once more for joining this webinar. I hope to see you on the other side. Cheers.